I mean, I'll sort of jump in there because from my experience as well, and it sort of follows up what Peter's just saying. One of the things I find a lot of people do is find, they come over to a trade show or something, and think, right, we've sold, and they meet someone, and the UK is full of people who are very good at talking at trade shows, and are not necessarily very good when they're actually running the business in the UK or dealing with operations. So again, it's very important not to get sold the tune, but actually do it formally and properly. And Peter and Zoe's expertise in that, because it's very, I've seen it so many times where they've said, oh yeah, we've met this really good guy, and then the guy's just not very very talented, not actually a driver, or not delivering anything on the ground. So it's a question of making sure you get local talent. I agree 100%, but do it properly, and don't just try to do it on an ad hoc basis, as I'm sure Peter and Zoe would agree.
Yeah, that's really sound advice there. In terms of the visa options, and this is the mistake I see, is that and it's all about you need that local talent, as Pete, and Ian have mentioned. Sometimes clients just send someone who's on a working holiday visa, because it's fairly straightforward to get these tier 5, they're known as tier 5 youth mobility visas. They're up to 2 years. It's for the 18 to 30s, and it's think, well, he's pretty game to do it, or she's pretty game to do it. Let's send them to the UK and see how it goes. That's obviously not the right way of doing things, as we mentioned. And also, even if they are the right person for the role, it's a short-term visa, 2 years. You've got to return, go back to Australia at the end. So if you're really starting to get traction after 2 years, it's the last thing you want to do. So have a look at some visa options. The first I'm going to mention is the sole rep visa. The full name is Representative of an Overseas Business Visa, but it's a sole rep visa. It's a once in a lifetime opportunity. It's before you start trading. It's before you start employing staff. You can send a senior employee. It could be you as the founder of the business, provided you're not a majority shareholder. It's an easy route if you haven't got a personal right to the UK. And you send your senior person who's going to set up a wholly owned subsidiary of the Australian entity, or a branch office. And a branch office is basically registering the Australian entity in the UK. We would advise on getting a UK limited company from a commercial perspective. And that visa is initially granted for 3 years. It's extendable by 2, and it can lead to settlement. There is a settlement option, so it's something that shouldn't be missed. It's all about timing here as well, because if you have a few people you want to send over, you need to work out who's got some maybe personal rights and who hasn't, and timing when they enter, because the sole rep has to be your first entrant to the UK. We can look at personal work visas, and Australians and New Zealanders alike have a few options when being transferred to the UK. It could be that the parents were born in the UK and British citizens. If that's the case, you've got someone who can get a British passport. If it's grandparents, then there's the ancestry visa. So that visa is granted for up to 5 years and can lead to settlement. Again, it's a really good, straightforward visa. It's based on your family line. Beyond that, unfortunately, you miss out. So if you're another generation along, you miss out on that. You can also consider whether the person you wish to send has other family circumstances that could lead to a personal work visa, and it could be their spouse, or they're with a partner who's they've been living with for more than 2 years. It has to be akin to marriage, and that means that you've got to live together they've had to have lived together for 2 years and can prove it. And there's a spousal visa option there as well. Failing that, we're back to the youth mobility visas, or if you're just looking for something short term from a personal perspective. I find that's quite a useful visa if you're looking to maybe keep developers in your team and they want to travel a little bit. The UK, coming to London, it's a great place to be. Who wouldn't want to come to London? And that visa's for 2 years, and it's a great experience. It might keep them engaged in the business for longer than you expect. Other than that, we are then moving on to Tier 2 sponsorship. I'm not going to talk at length about Tier 2 sponsorship, but it's basically where the the business becomes a licensed sponsor and is able to sponsor staff to come to the UK, provided they've got a highly skilled role. The rules on this are changing, so come the new year, there seems to be a bit more flexibility around sponsorship, so watch this space on that. If you're the owner of the business and you really need to be in the UK and you don't fit any of the other options, there are other visa options for you, but the one that I find more success with is the global talent visa. And this is where you're talented and promising, or a promising individual in the field of digital technology. It isn't as straightforward as the rest, so always look at the other options, but it is a really good visa to get. There is an endorsement process, and in the field of digital technology, you get that from Tech Nation. So get pally with them, start speaking to them, and just to see what their take is on you being successful in an endorsement. It's very document heavy. It's you selling yourself, why you're going to make such a great impact on the UK, and it's also who you know as well. So referees are needed in this. So if it's leading figures from digital companies that you've worked with who can vouch for you and say what a great person you are and what the UK is going to get out of you, and what you're going to deliver to the UK, then you're well on your way. So there's an endorsement process, and then the visa application process, which is a formality. You can get up to 5 years in this visa route, and it can lead to settlement. Those are your main options for visas. The last one I've left on is business visitors, which is just visiting the UK for certain permitted business activities. Don't think that allows you to work. You've got to be very careful. Normally, this is a great visa for exploring the UK market if you're doing a visit, or part of what we normally do on a trade mission. And likewise, if you're set up in the UK and you want to remain in Australia, but you're the director of the UK business, it's great to come over to attend meetings with your staff. You can enter the UK for up to 6 months. You do need to get the information with you, because you will be questioned from time to time at border. The key thing is you're not here to work. Don't make the same mistake a client once did, who had someone over on a business visitor who's clearly working. I advised them that this isn't the right visa. They're only just setting up, so that person could probably fit into the sole rep route. So I said, get them home as soon as possible, and they did. What they didn't tell me is they then sent someone else just to cover the work, who had a load of documentation saying, whatever you do, don't tell the border control that you're working, which they obviously got sent home on, and it took a long time and cost to unravel. So don't abuse this visitor visa. The other thing to consider, if you're just using it for the permitted activities, is your time spent in the UK. If you're spending a lot of time in the UK, it could lead to tax residency on a business visitor. You don't want that, because then you should have been on a UK payroll. And if you're spending, basically as a rule of thumb, more than 183 days in any 12 months or in a tax year, you're going to be triggering tax residency. So you've got to be very careful with your time spent. Likewise, if you've got a UK company, the UK company will have reporting requirements for staff coming to the UK for visits. If you're spending more than 59 days, they'll have to report you to HMRC just to say that you're here and why you're not going to be put on a payroll. There's little things that you need to pick up on there. So that's the main gist of visa options. Ian will now run us through payroll, taxes and pensions, and also give some top tips on company setup and structure. Ian, over to you.
Thanks very much, Ross. So Ross has touched on a couple of these bits, but I'll just give you a bit more information on why maybe secondments are very useful. In terms of actual setup for payrolls, they're very straightforward. It typically takes between 10 to 15 days to register a payroll scheme with HMRC. And it just depends on their backlog rather than any inefficiencies at either our end or your end, indeed. But typically you can have the scheme up and running relatively quickly. If you want to employ someone and you haven't got the formal registration, that can still be done we can do it sort of on a sort of provisional basis if necessary, if you suddenly got an urgent need, but hopefully things are a bit better planned. It does happen occasionally. And payroll taxes, the main ones you need to be aware of are really the on costs to you. So in addition to salaries, there's our national insurance charge, which is 13.8% of the gross salary. There's a lot of, at the lower end of the pay scale, there are sort of, it falls a bit, but it's just simple to keep that number in your head that you're going to have a salary cost plus 13.8%. In addition, there's a minimum pension contribution under auto enrolment of 3% for the employer and 5% for the employee. It is possible for the employee to opt out of that. Quite often that's done in conjunction or discussions with the employer. If they're feeling bright and young and feel that they're never going to retire for the next 50 years and they really don't want to lose part of their salary, but it's very much discouraged. Obviously, the whole point of auto enrolment is that it's trying to make sure people, in an aging population, people are providing for their retirement. So, but you can opt out, but that doesn't mean you don't need a scheme. You still need an auto enrolment pension scheme as soon as you set up a payroll. And we offer that service of doing it. It's quite straightforward. It's a low cost to just run a basic vanilla scheme if you need it. In terms of the company, the reason, Ross alluded to earlier, was it's easier to set up a company than a branch. The reason for that is once you've got a UK company, I think everything's easier in terms of commercial operations, registering for payroll taxes, opening a bank account, which I will let Ross talk more on shortly. That's less hard, should we say, less difficult with a UK company. It just means people understand it over here. So quite a lot of, if you're hiring equipment, for example, or you're trying to rent some premises, people understand, oh, it's a UK company. They're like that. It's easier to, just operate without, as a base level. It's also easier for investment because, you've got UK company shares that potentially could be invested in, although I'll talk about that a bit later in a bit more detail. We also have very flexible incorporation rules. So it's very easy to form a company. Typically, we can form a company within 2 hours. There's no there's no wet signatures required. We have moved on into at least the 19th century as the UK now. So everything's electronic, everything's can be done online, and you don't need to have a director over here. So you can form a UK company with no resident directors, which is quite a big help. There are a couple of times that sort of can bite you. Bank account, Ross will come back to. A few of the banks won't open an account unless there is a UK director. And I'm not sure on the panel today, I don't think we have anyone who's likely to be registering with FCA, but if, there's, which is the Financial Conduct Authority, if you're in financial services businesses, then they will require a UK director. But as a base rule, very easy. Also, minimum share capital, you can open it with, even less than £1, but £1 of share capital, is the sort of commitment. So there's no minimum share capital requirement. So very easy to set up, easy to invest, easier to operate. And we also have one of the largest tax treaties in the world. So in terms of tax efficiency, it can be very helpful when you're dealing with, particularly most of the sort of major countries. I think in terms of the bank account, that's the biggest headache. I'll pass back to Ross because he's very good at having a rant about the UK banks. It's our biggest problem with regard to inward investment, is actually just getting a corporate bank account. But Ross, did you want to say a few words?
Yes, so probably your biggest challenge is surprisingly getting that corporate bank account open. I'm sure Pete will jump in on this as well because he's seen the pain that clients have gone through. Pete, you'll have a lot to say about this as well. It is challenging. It's all about know your client, the AML that they require. It's a long, painful process. It feels like they're almost looking at a computer and saying, computer says no. At best, it could take 3 months. with the traditional banks can take up to 6 months if you're lucky in times. The problem we're having at the moment, so your NatWest, your Santander's, HSBC, Metros, they're saying they're not open for business until 2021, which is really disappointing. Silicon Valley, US-owned bank, they're amenable to opening, but they really focus on fintechs. That's the main focus at the moment. So where does that leave you? Luckily, we've got these challenger banks, and it's they won't offer you the full banking service, but they meet the needs of most customers, and it's look at exploring them. Revolut, the Tides. The one that I really like at the moment, the one that I'm sort of pushing people towards, is Cash Plus. The issue with Cash Plus is that it costs you £1,000 to get set up with them. There's due diligence that they carry out, the AML. That's the costing, and if you're not successful with the AML, they'll just say no, turn around and say no, and you lose the £1,000. But what I find with particularly tech companies is that they're very amenable to tech companies open up. So they're the one that I would explore as a stopgap, and later you can move to the traditional banks. You can get that support. But yeah, that's my view at the moment. It does change. We ourselves support our clients trying to get the bank account open. We'll help with the AML because we've got to engage. If we engage you as a client, we've got to do a lot of that AML, and we'll speak to the banks. It's just with the traditional ones, they've got harder and harder over the last few years. So we look at other opportunities. I don't know if you've got anything to add, Pete or Ian as well.
Sure. I mean, I think it's something that has become an issue and continues to be an issue for overseas companies looking to set up bank accounts. You would hope it'd be easy, but yes, AML and KYC has obviously got in the way of our lives. What I will suggest, though, there are ways of speeding things up, and that is really using the network. So we have very good relationships with UK DIT. London and Partners and other trade organisations, and also through the Fintech network and in general, which is a very good access to the banks, we can definitely speed things up. And there are individuals within some of those banks who can actually, take hold of a situation and open doors. So see case by case basis, but you can be smarter about it and use the network, or you can try and go down the traditional route and you'll be in a queue.
I think banging your head against a brick wall is probably as well. Yeah, absolutely.
Yeah, that's the best way of describing it. But yeah, that we Newfound ourselves, we've got those leads, those connections that will help you along that way. We definitely see that as a challenge for everyone, and it, we look to support you on your setup on that. In terms of the next things, I think I call these the juicy bits, actually, the R&D tax credits and the investment opportunities in the UK. And I'm going to pass to Ian here, who will talk you through, the considerations.
Yeah. So one of the key reasons, actually, one of the main reasons the UK, a lot of UK setups is the R&D tax credit system. We always say it shouldn't be the primary reason. There should be a good business operational reason why you're looking to come to the UK, a commercial reason. But once you've made that decision and you're looking, that it is possible that you may qualify depending on your business for R&D tax credits. The system's much more flexible than it is in Australia. It's more open. You don't need to register into some sort of formal process. Claims are just made annually as part of your corporation tax return. You do need a UK company, another good reason to have a corporate structure. But the claims are less rigid. What you really need to do is just make sure that the R&D work is being directed from the UK, and that ultimately there could be some benefit to the UK in respect to that R&D work. So you don't need to spend the money here. The money could be spent back in Australia, for example. It could be, you don't even need to spend it yourself. It can be spent with subcontractors, although that does tend to reduce the amount of credits that are available. So it's a very flexible system. I mean, basically the UK, I think realizes that as with the horrible B word of Brexit looming, we need to do everything we can to encourage technology and technological development in this country. So the system is very generous. I mean, there are a few restrictions, and who knows what will happen as a result of the COVID thing with taxes. But this is one system that seems to be very much sort of flavour. We've been very successful in making some substantial claims. So the basic reliefs that are available at really high level are that if you spend, say, £100 on qualifying research and development expenditure, you get a tax deduction of effectively £230. So for every £100 you spend, £230 deduction against your profits. If you don't have taxable profits, that cost can create a loss, effectively a tax loss. And typically what would happen in the UK is that would be carried forward against future profits for the company. But actually there is an option here to cash in those losses, depending on the scheme you're in. But the sort of main scheme that we tend to see, you can cash in losses up to 14.5% cash back, and that's real cash. So if you're investing in a sort of startup business, or you're looking to, you've got a lot of developers working on tech for you, then effectively what can happen is, you can get some partly cash funding for that expenditure through the UK tax system. There are obviously quite a lot of rules around it, but the key thing is you'll be surprised at how widely drawn the rules are. So that as long as there is some technological development, you're solving a problem, then there is a good chance you may be able to qualify for this. And we don't have the sort of expert in this country as the tax inspector, HMRC. And while they employ, obviously some technological experts, the reality is they don't really have massive expertise. So, the reports can be drafted in such a way that, it's not going to be tested by 20 scientists saying, does this work? It's very much a sort of overview of, actually, yeah, that looks reasonable. We think this has got a benefit. We'll go ahead with the claim. The other thing to bear in mind, there's no minimum spend, so R&D claims can be made on very modest sums. So mostly it tends to be obviously salary costs, staff costs, and an apportionment of overhead as well, which is still, it can be worth it. If you can get 14.5% cash back if you're a loss-making business, that's definitely beneficial. If you're a profitable business, then obviously the tax deduction is even more valuable. So give it some thought. We're happy to always have a quick overview at things to see if we think it may qualify. Moving on to investment opportunities. One of the reasons I've said about the corporate ownership, definitely the quickest route, definitely the easiest. One reason some people do set up a branch is that if they're looking for UK investment particularly, we have this wonderful thing called EIS. I'll concentrate on that. I'll mention briefly SEIS afterwards. EIS is a very favourable tax relief for UK investors. If they invest in an EIS qualifying company, they get 30% income tax relief in the year of investment for investments up to £1 million. Provided the EIS shares don't fail tests for a couple of years, 2-3 years afterwards, they get capital gains tax relief on the sale of those shares. There's no capital gains tax if they sell those shares for a profit. There's a lot of qualifying rules both for the investor and the investor and the investee, which I won't bore you with here, but just as a base rule, if you're a trading business, it's a genuine business doing a trade. It's not a sort of property-rich trade such as a hotel or something like that where the risk is reduced. This is supposed to support risky entrepreneurial businesses. Then it may qualify. The issue is that the investment needs to be made in the top co of a group, so holding company of a group. It cannot be made into a subsidiary. So hence, quite often, so anyone with EIS investment to an Australian company would have to be investing in the Australian company. And for that to qualify for EIS relief, it needs to have an operation here. It needs to have a permanent establishment, or we call them we still call them branches. That's, people seem to understand that better, but the strict term is permanent establishment here. So it needs to have an operation here. It needs to be actively doing things here, and it needs to demonstrate that there is a UK business that is being developed as part of that. It doesn't have to be the whole business, it needs to be part of it, and that will then, in theory, give you access to potential EIS investment. You've still got to persuade people to invest in Australia, but that happens quite regularly. That's, people are getting much more sophisticated about that, about investing overseas. But having a branch, there's a couple of, so the downside to a branch is that you have to publish your holding company information, that company's house here. If it's not in English, it needs to be translated. It's not an issue for most Australian companies. And you have to, so provide a lot more information that you may not wish to do from a sort of commercial perspective. But it's one route, and it does mean that the branch, again, because it's a branch, sometimes registering the payroll scheme, registering a company's house takes longer. It's a bit more painful. Getting the bank accounts can sometimes be more painful, bizarrely. So there's a whole range of things to consider. But if investment's key and fundamental to you, it's something that certainly should be considered.
Ian, if I could add to that
sure.
point, I mean, it's certainly there's going to be obviously a session covering investments later on, but I'm an investor myself, and I've invested in companies coming in from Australia and New Zealand, and I think it's a wise thing to consider here, because suddenly you're accessing an angel network that is there to support your businesses, and before necessarily going to the VCs are different, of course, but for angels, and particularly the angel networks that are in London, the UK, are pretty sophisticated, and they tend to be from industry, and so it's smart money. Hopefully, that's what you need to access, who can actually help you in your business aims. And as I say, under EIS regulations, as an investor, it's very attractive. So there's a large amount of angel cash available in the UK.
Perfect. I mean, I said I'd mention SEIS very briefly. If this is for really very small startup companies, that's probably not relevant for most of you, but you can't have assets of more than £200,000 at the time of investment. So it tends to limit things very much. But from the investor's point of view, they get 50% income tax relief on that. For a maximum of 100,000 per investor. So it's just, if your company is very small, it's more of just a mention. I've tried to leave 5 minutes, which I think I have. We sort of called them business hacks, AOB, and obviously Zoe, please feel free to jump in. Pete, feel free to jump in. This was really just a few top tips, I think, for companies. I mean, just one. Given that I'm talking, I'll just start with one that comes across. If you're looking for offices, if you're at that level where you're thinking, actually, we do want an office, just please don't jump at the first leased premises that you find. I mean, one of the things that we've seen time and again, particularly from US companies, actually, where they think they know better quite often, is they will take the last 2 years of a lease. So they think, oh, great, we've got we've got fantastic London office. There's 2 years left on this lease, so we're getting it at a really good value. And what they don't realise is there's this sting in the tail for leases in the UK, which is this thing called dilapidations, where if you are the last leaseholder at the time the lease comes to an end, you have the obligation to put the property back in the order it was in at the start of that lease. So we had a US company that got the last 2 years of a 25-year lease. We're very proud and smug until they got a bill for £2.5 million for putting the office back as it was 23 years before they leased it. We did manage to sort of get them out of that in the end, but it's one thing to bear in mind. So don't take cheap premises. I think certainly now most people are obviously in the serviced office space. If they're looking for offices, just hires of meeting rooms and things. And certainly in this world, we're now living in this digital world. But if you are looking for an office, don't fall into that. That is a bear trap that we've seen many times, and it's a very, very expensive one. So that's my number one just as a starter. I don't know who wants to jump in next.
I'm happy to give a few insights, and I'm sure Zoe will as well. But I think when it comes to those first feet on the ground, whether it's people from your HQ, whether it's yourself, or indeed your first hires, it's tempting to sort of come to London, and London may be the perfect place for you to sort of set up in, but of course there is much more to the UK than London. And to me, the number one rule, is around the people. So if you hire locally, then that's going to be dictating where your office is going to probably be. And then of course where your customers are. So, think about where your customers are going to be mostly based, and they could be spread across the UK. So think about transport hubs, but also think about the closeness to those customers, because we will be allowed to go and meet people very soon, hopefully. And yes, of course, we can do lots of Zoom calls, but ultimately people will need to meet. So I think, where you hire, that's critical, and obviously where your customers are. And they're sort of two of the top tips that I would say are critical to where your first physical location is.
Thank you, Peter. Absolutely. And I think just thinking about onboarding people early in the process as well. How are you going to get people up and running virtually at a distance? Who's going to buddy up with them? Are there any coaches internally that can work with the people? And also think about you as a leader. How are you going to connect with people at a distance? How are the time zones going to work? How are you going to schedule those one-to-ones? Because it's often overlooked, and as Ian said earlier, we get very enthusiastic about people telling us they're doing all the right things, and trusting people first, of course, which is important, but as a leader you'll want to know what's going on every day. So really thinking about the onboarding plan, the connection points, how many different people can support your new hire as they onboard successfully. So very important to do that. And operationally, from an HR perspective, it may be that you've got hubs around the world already. So going back to the previous slide around payroll and adding on benefits, do think about whether you've got a payroll provider that you've already got a service agreement with that has an arm in the UK that you might be able to extend your global provision of services with, or indeed from a benefits perspective, think about it as a global benefits platform. So be very mindful of that. It's easy to go into each country and have bespoke arrangements for every country. Obviously every country is different, but it's very important to see this as a holistic view. So if you've already got global benefits set up in other territories, okay, well, how can we match those? What will work in the UK market? What's going to be attractive to candidates there, so that we have that kind of fairness and equity all the way through the company as we set up. So two things just around payroll and benefit. Just don't think about it as UK, try to think bigger than that, and how will we replicate that in the UK market?
Yeah, and just to add to that, it's all about embedding them, because as Zoe mentions, you're in different time zones. Don't just stick to where you normally hold the meetings. Think about everyone. Try and remember this new team you've got in the UK of more than just a monthly criticism for lack of sales, for example. You really got to bring them into the business and make them feel part of it. It's so important, and that is all part of that onboarding process, making them feel that this is a great team and being so engaged. I think it's the best way. And something that Pete alludes to as well is about the London and partners of this world, the UK DIT, gather that information, get some really good information. You might not be setting up in London, but you could explore the London market of whether London's good for you, and London and partners would be interested in talking to you. It doesn't necessarily mean you've got to set up in London. You'll find that as you go along where you need to be placed in terms of your customer pool and your talent pool, and it's looking for those options. You can come to Newfound, you can come to us and talk about, well, can I get any of this information? And we normally know someone who can to help you with your setup.
One further thing. Sorry, Elizabeth. Sorry to interrupt, but has Brexit been covered? Or is it going to be covered in terms of, is it going to impact you being able to do business in Europe versus, just the UK? Because I think, that's probably quite a salient point for some of the companies.
I think we should open it up for the last half an hour to our companies to come in with the questions that they might have. So if you are one of the, if you've been listening diligently for the last half an hour, we hope it's been really interesting. If you want to activate your video now and raise your hand, and I'll call on you.
This is where we see if everyone's asleep or not.
Yeah. see if people have been paying attention. Do we have Dylan's turned on his video? I don't know, Dylan, if you have a question. There we go. Yes, we can hear you.
Yeah. So when you were talking about starting up a UK company, there's a few questions around that. Would you, like with VAT in the UK, should we start a VAT registered company?
So VAT registration is not obligatory until you start turning over, having revenues in the UK of about £85,000. So day one, you don't need to register. That tends to be a business discussion around cash flow. So obviously if you do register straight away, then you can start claiming VAT back on your business expenditure. So if you're going to incur quite a lot of business costs that have VAT, then which is at 20% in the UK. So if you're paying £100 for for some IT equipment, you're going to get charged that £20 VAT. If you want to be able to claim that £20 back, then you can register. You have to sort of balance that versus the actual cost of doing the VAT returns, the compliance. So there is obviously bookkeeping requirements. There's at least a quarterly VAT return to do, so where you have to sort of make the return to HMRC. If you're reclaiming substantial amounts of VAT, then you can do a monthly return, so that helps your cash flow. It takes typically, I would say at the moment they're not too bad. I would say 10 to 15 days to register, working days to register for VAT. You can claim VAT in advance of registration, so you can sort of delay it a bit if you think I'm not sure quite what costs I'm going to have. Obviously salaries aren't subject to VAT, so most startups tend to be people on the ground getting, it tends to not be a huge cost from a VAT perspective. But you've always got the option, you can claim VAT from for services up to 6 months before registration, and for goods up to a year. And basically, if it's still in existence at the time you register, so if you've bought 10 laptops, and you think, right, actually, yeah, we're going to register now, even if it's 15 months later, those laptops still exist in the business, they're being used for the business, you can then go back and claim that VAT. So it's not something you have to decide day one. If you know there's going to be a substantial lot of costs, then we would always recommend registering, because it's going to speed up. What you don't want to be doing is suddenly finding, 6 months down the line, I'm desperate to register, and then having to wait for a bit if HMRC are being a bit slow. But
it's good advice on the mechanics, but I think also the optics are important here as well. So I think, if you are going to sort of do business in the UK, you need to be perceived or seen as being almost a UK business, because otherwise it's going to be harder to sell into particularly enterprises, because they won't necessarily see you as committed to the UK. And I think to invoice as a UK entity to a UK corporate and not have VAT will be seen as odd.
It would be.
Yeah. So I think just for the optics alone, because you have to be seen as local pretty quickly, then I would register for VAT from day one.
Yeah. And I would add, as someone who had to register a company that had existed for quite a while without a VAT registration, the 20% VAT will be viewed by your clients as a price increase when you apply it. So even if it's a tax, it's often easier just to incorporate it from the beginning, because if you come along 6 months in and say, oh, this service that we've been charging is now 20% more expensive, that's quite a challenge as well in some of those conversations, particularly if you're selling into smaller businesses or to individuals. So from that perspective, being VAT registered and just having your prices set from the beginning is helpful too.
Okay.
Makes sense. Yep.
That sounds like that was a pretty good, thorough answer. Thank you.
Yeah.
And I had another question while I was here, just on the video. It was to do with the EIS and the SACE, and you kind of skipped through it reasonably fast around it has to be investment into the sort of upper echelon of the company. Does that mean that it's only open if you're sort of an Australian company coming over here, over to the UK? Does that mean that it's only open if you are going to follow the branch, or if you create a certain version of a UK company, you could still make that the sort of upper echelon of that version of the company, if you get what I mean?
Yeah, I think it's I think I get what you mean. So I think what you're saying, if it's not, the key thing is it can't be a subsidiary. So so if you obviously open up a subsidiary of the Australian company, then you can't, there's no EIS relief available for that arrangement. So so it's only available if you open if you are as a non-UK company. It's only available if you are setting up a permanent establishment, a branch here. So, but what some people do is have a sort of parallel existence and say, well, actually, we won't form a subsidiary. We'll form a UK company, which obviously has tax implications for the owners and other issues. There's commercial issues around that, so I'm sure Peter say as well. Is perception of who are these people and where's the connection. So and in theory, if you do that, you could have a UK company with EIS investors, but you've got to be very careful of what are you actually doing. There's a lot of anti-avoidance legislation of what is of substance over form. So while you may say, well, actually we're two separate companies, are you really being directed by Australia? Because control forms many there's sort of anti-control measures, etc. So I think you've got to be very, very careful how you do it. I mean, we found from experience that because HMRC look quite closely at these, because it's not straightforward as here's a UK company, you're investing in it, it's trading here, it's doing stuff. So they tend to look quite closely at the branch registrations anyway. So I think you want to be careful. What you don't want to be doing is 18 months down the line, HMRC are sort of suddenly saying, well, actually, you're not really separate. You're effectively part of this group, and there's nothing more. I'm sure Peter will agree. There are many reasons why EIS schemes fail. Some for very good reasons that they may sell out or for good money or whatever, before the 3 years are up or whatever. But it's a question of they fail for a lot of bureaucratic reasons, and HMRC, despite the fact they love giving this relief and selling it as this is a great investor relief, love to trip you up if they can. So they're always looking for reasons why it doesn't work. And there's nothing worse than an EIS investor having had their tax refund and then a year later being told, actually, you're not entitled to that, pay it back because we've now found something. So I think you just want to be really clean and tidy. I would suggest if you're looking at EIS, you really want to be doing, a branch, permanent establishment route, unless it's really separate and you think, you've got a different business model, different something. Would be my commercial advice. I don't know if Peter's got anything.
I think there's a few other factors. It's whether if you're the owner of the business, are you remaining in Australia and you're looking to do this? Because if you're looking to get all the profits fed back up to Australia, you probably better go into the UK limited, and then you've got opportunities. Do you need the investment in the UK? You may have already dipped your toe in other ponds already and getting investment from there. And if you do initially set up as a UK limited company because you don't need a subsidiary, because you don't need that investment, it's something that you might be able to look at later down the line and restructure. And if you get into something like Series B funding, doing the restructure and the cost of that is going to be negligible to the investment that you're getting. So it's something to bear in mind. If you're dipping your toe in the pond for the first time and you need the investment straight away, then look closely at the structure. Otherwise, if it's something that you may need later on, the simplest, safest route and from a commercials perspective is that UK subsidiary.
Great. And I think David's been waiting patiently with his video on to ask the question. And then after David, we'll go to Erwin.
Just more on that EIS. Is there a time frame around when first investment needs to take place?
Yes, there's massively one thing you learn in the UK tax rules: everything is 20 times more complicated than you would like it to be. So there are timeframes where that you've got to be trading for 3 months as a starting point. So there's a minimum period where you've got to be active and trading for 3 months. So you can't even start registering for EIS scheme or registering with HMRC until that period's gone. So that's a start point. And then effectively, but after that, there's asset limits on the company. So if the company can't have more than £50 million of assets of value, so there are various other really detailed nitty-gritty restrictions. I mean, what I can share with new founders, sort of couple of, we've got some sort of quick guides and some basic information on it, which we can upload with Elizabeth to add to the sort of post thing forum is probably the easiest way, because it does get complicated. But the key thing is you you can't be raising this funds or looking at this until you've been trading for 3 months. Is the key one, and then really within that period, within any 2-3 years after that, you'll find there is a limit, an ultimate limit of 7 years. If there's been a trade that's been going on for 7 years, no matter where that trader has been operating, then it's sort of gone, because effectively the revenue will take the view that risk has been mitigated. So if your company back in Australia has basically been trading successfully for 7 years or more, then you wouldn't be able to qualify anyway, because it's classed as a sort of more mature trade.
And are there other grants available, like export grants, equivalent to what we have in Australia, or?
I mean, just as a general rule, I don't know if Peter's got more. I'm not a grant expert, I have to confess. So, but from my knowledge, they're much more limited in the UK than they are elsewhere, generally. But there are very much local, depending on what you're in. So there are sort of things like R&D. The R&D is sort of viewed as a grant. There are certain local grants and certain local investment reliefs, typically in sort of local jurisdictions where it's a sort of, we had what's called enterprise zones historically in places like that, where it's like we're looking to attract employment, so you may be able to get grants, but the grants are quite limited generally compared to what they are in Australia. But Peter, I don't know if you've got any more knowledge of that. I'm not a grant expert, but I just know generally we don't like giving away money.
I think you've nailed it in one, Ian. There's money, in certain geographical areas, particularly when they want to attract inward investment and jobs. So the more exotic parts of the UK, but still could be
Wales.
Ideal. Wales, Northern Ireland, but actually, I mean, Northern Ireland's offering some tremendous R&D tax credits and also attractive incentives. And there's some fantastic universities up there, so you can get some really good developers out of Northern Ireland. So R&D down there is ideal. But in terms of getting money from the government, it's not going to happen.
Although if we think about the current debate around Brexit, Dominic Cummings is fighting very hard for the UK to be able to break EU law in terms of being able to support tech businesses. So watch this space in 6 months' time. If Dominic Cummings has fully taken over the government, there might be some more grants.
There might be some more. We won't have any trading partners, but we'll have grants. Yes.
Exactly. We'll move to Erwin now, who's been waiting patiently.
Thank you. Sorry, everyone, for being so late on the call, which is one of the reasons why I'm asking this question, because it's in relation to a JV that we're potentially landing in the UK. But before I jump into that question, you mentioned that the EIS doesn't qualify if the value of the company is over 15 million. Yeah. Was that right?
Correct.
Okay. No worries. Yeah. Thanks for that.
Yeah.
In terms of a JV, does a JV qualify for EIS? Do you know?
If it's not, well, it depends on the structure of I mean, JV covers a multitude of sins, as I'm sure you'll appreciate. So it depends on the structure of that. The key thing is it cannot be a subsidiary. Yeah. So it is potential. You've got 4 corporate owners potentially, that each got 25%. But again, it comes down to where control is. But if you're setting up a business and you're saying, well, actually, we're going to be investing some of the share capital of this business, we're looking for sort of co-investors, that could potentially qualify. Obviously happy to have a discussion, but so potentially it could. It depends on the structure, yeah. So, but
okay.
Yeah.
Oh, I'd be flagging myself for that discussion.
Fine.
If I could, just a little bit, that'd be great. Thanks.
No problem. Thanks,
Ian.
Erwin. Yeah.
Also, pitfalls and benefits. Is there any in relation to landing in a JV with an Australian company, for example? Is there anything that we should be looking out for?
I'll let Ross discuss in a minute. He's more the lawyer than I am, but I mean, just from a pure commercial viewpoint, make sure the contract's fair. It's like anything, it's just depending on who your JV partner is. People do tend to get bullied because they're quite often, they see it. This could be a great partner. If it's a larger organisation, particularly, so just do make sure you're not bullied into sort of accepting terms that aren't necessarily, acceptable. But other than that, it's a structure that's used, a lot over here. So people understand it. Yeah, I mean, it's typical, usual commercial things. From a tax point of view, there's no particular issues. There are some, you know, some weird reliefs available. There's a sort of consortium relief where you've got more than 20% of shares. There's certain tax, you know, loosening of certain tax restrictions, etc. So there's a few issues, but I don't know if anyone else wants to add anything.
Yeah, I think it, as you say, and it's down to the commerciality, the bargaining power. You know, check the T's and C's that there's not something untoward. Get you know, someone local to review those and just check there's nothing that sticks out from a commercial perspective that could really land you in a mire. You know, not what you expected from the JV. I mean, we've had clients who go into JVs, you know, in you know, food retail, and it's been highly successful because I think there's more of an equal bargaining power there, because it was a win-win situation. I mean, it's the same really when you deal with, choose your investors wisely. Sometimes you don't want investors that sort of take over your company if you're looking for investment. It's the same thing when you're looking at JVs.
Okay, so nothing. I mean, besides all the standard kind of sensible, sensible stuff. I mean, there's nothing really around sort of UK tax that we need to be aware of, or any, you know, that's relative directly to JV structure.
Not directly, no, it's fine. No.
Cool. Thanks, guys.
Do we have any other questions in the room? People see a great opportunity to get that practical advice from our experts. Do you have another one, Dave? Oh, Dion, hi.
Hey, g'day, how are you?
I'm well. How are you?
Not too bad. Look, we already claim R&D here from a loss-making position, so we get the tax rebate. What advantage do you see in the UK of us doing that over and above what we would do here? As in, do we need to transfer? Is there an advantage in transferring the same cost base across to the UK and claiming there?
I think there are some anti-avoidance issues as well regarding if you're already claiming R&D on certain expenditure elsewhere, then obviously we're less likely to do it. But obviously, in terms of going forward and saying, you know, I think, you know, it's a number crunching exercise, David, where you say, well, actually, this is what we get at the moment in Australia, you know, and this is how it works. And if we moved, you've got to obviously bear in mind the costs of setup and the bureaucracy, which is not, doesn't have to be too onerous, but, you know, then it's just saying, well, actually, in the UK, we're going to get this relief, we're going to get this cash, and it's a straight equation. You know, it's a mathematical. Is it preferable or not? But, you know, we just have to get over the hoop of, there is a bit of an issue around. Sorry, Ross, did you want to say something?
Yeah, it's the double dipping issue.
Double dipping.
That you're not dipping twice for this.
Yeah.
I think the key thing to if you've been successful with it in Australia, I think you're going to be successful with it in the UK. It's a loss, you know, it's less rigid. It's like it's on the tax return like a sheet of paper compared to what you've got to go through in Australia. The IP can remain held in Australia. The developers that you're using can remain in Australia. It's just that it's got to be directed from the UK company. But you just got to check that what you're claiming for, you're not dipping your toe in twice for that.
Do you see a distinct advantage between the two, either or?
I mean, I think overall the general recovery is, from our experience, has been higher in the UK. It's certainly something that tends to sort of the actual cashback, but you've got to weigh that up against the costs.
I've seen clients who've flipped the company to the UK because of the amount of R&D they're claiming, and put the holding company in the UK, and they're like, this is great, this is where we're going to put the IP. You know, I wish I'd done this years ago.
But obviously we could give you a bit more information on that again as well. We can maybe upload a bit of information on the R&D stuff as well to you guys.
And, maybe include the most effective structure there as well.
Yeah.
Yeah, I can definitely confirm that. You know, I can't think of any Australian tech company that hasn't benefited from UK R&D tax credits over and above what they can get in Australia. So I think it certainly seems to be a more generous scheme here in the UK. So you should definitely have a look at it.
Perfect, thanks.
I turn myself on mute. Do we have any questions particularly around staffing or hiring those first staff members? I know having Zoe here is a real great opportunity to talk about that culture and bringing your first person to the UK. So I just want to check that nobody has any questions around that. Okay. If
I could make a comment on it. I think it's, because, I mean, I'd back up what Zoe said, is that, there's a massive, although we've got unemployment rates going up, it's very difficult as a successful business to attract talent. We have the same issue. So I would just say what's fundamental is getting that corporate brand and becoming attractive. So I'd really just like to back up what Zoe's saying. It's people, people are choosy where they work, even in this world, in this day and age. If you want the best talent, there's got to be reason. There's got to be an attraction. There's got to be something over and above the job. It's not people are less attracted by money. I mean, I would certainly say sustainability is a massive issue. We see, how sustainable is your company? Is it, are you ethically, and morally sort of viewed as a good place to work? So just as a comment, it's certainly something that we see more and more of.
And I would add that at the moment, obviously, we've seen some redundancies in the UK, although as you'll hear in the next session, funding is still quite high. So it is actually a brilliant time to be finding really talented people here in the UK market. There are people who've left companies that haven't been as successful because of the current COVID crisis, and they're looking for new opportunities, and a lot of them have a huge amount of experience. So when you're thinking about who to hire, this is actually a fantastic time in the UK jobs market to be finding people who are really skilled and really ambitious who haven't been able to find the right job.
Yeah, I can vouch for that as well. There's a lot of people who've had to suffer pay cuts due to COVID-19, and there's a lot of frustrated people out there who, if you can give them a new opportunity, they're probably ready to move on.
Yeah, and the opportunity to build something sustainable and be part of the success of a longer term proposition in the UK is very attractive to a lot of people in those markets as well.
I mean, it's definitely, as Elizabeth pointed out, it's definitely easier to hire. In fact, hiring at the moment is not problematical. It's hiring the right person. So do not compromise on quality and do not compromise on fit. You've got to have someone that brings, everything you need. Otherwise, you're just putting more risk into the business. So, yes, hiring an average person is dead simple. Hiring a great person is hard.
Yeah, I mean, I've got an example. One of our clients, they're looking for a CEO to drive the UK market, and they ended up with their fifth choice. And they just went for it because, we didn't have anyone else. And yes, they needed someone in there, but I think there's probably a bit more patience. It didn't work out in the end.